When you look at the traders who turned small, ordinary accounts into massive, life-changing fortunes, you probably imagine they had a secret formula, some mysterious strategy that made them win 90%, maybe even 100% of their trades. That's the fantasy most traders chase. High win rate equals high success. That's the myth. But the truth, the real truth that separates the legends from the crowd, is far more uncomfortable. Most of the traders whose names you know, Jesse Livermore, Paul Tudor Jones, George Soros, Stanley Druckenmiller, Richard Dennis, they all shared one shocking trait. They were wrong more often than they were right. Some had win rates as low as 40%, less than a coin flip. And yet, they didn't just survive, they thrived. They built empires in a game designed to destroy emotion-driven traders. How? Because they understood the one rule the masses never truly grasped. You don't need to be right to make money. You just need to manage what happens when you're wrong. Most beginners walk into the market with a dangerous illusion. They think trading is about winning as often as possible. They chase strategies that promise 80%, 90% accuracy. They think being wrong means being bad. But here's the truth. In the markets, perfection is poison. You can win 9 out of 10 trades, but if that one loser wipes out all your gains, you're not a trader. You're gambling with better lighting. The moment you start believing win rate defines skill, you've already lost the psychological battle. Because trading isn't about how often you're right. It's about how well you handle being wrong. Jesse Livermore, the man who shorted the 1929 market crash and made millions while others lost everything, said it best, "The game taught me the game." And it didn't spare me the rod while teaching. He wasn't talking about winning trades. He was talking about pain, about discipline, about learning how to lose without losing your head. Livermore famously added, "The difference between successful traders and unsuccessful traders is the ability to take a loss." Every trader loves the winning side of the story, but the truth is every fortune in trading is built on controlled losses. Paul Tudor Jones, one of the greatest living traders, echoes the same philosophy. The man who predicted the 1987 Black Monday crash doesn't have a motivational quote about being fearless or brave. Instead, he keeps a sticky note on his desk that says, "Losers average losers." That's it. Just 4 words that could save most traders from blowing their accounts. What he means is simple. When a trade goes wrong, don't add to it. Don't average down. Don't let your ego dig a deeper hole. Cut it. Move on. Live to fight another day. Even George Soros, who broke the Bank of England, didn't care about being right on every trade. He once said, "It's not whether you're right or wrong that matters, but how much money you make when you're right and how much you lose when you're wrong." Soros wasn't chasing perfection. He was chasing asymmetry. Small, controlled losses and large, open-ended wins. That's the formula every professional trader understands. Stanley Druckenmiller, Soros' longtime partner, once said something that should be tattooed on every trader's monitor. The key to making money in this business is not being right all the time, but being right big. Think about that. You can lose small 100 times and still come out ahead if your few wins are massive. It's not about accuracy, it's about risk to reward. Now let's put this into perspective with the math that most traders never learn. Expectancy, a simple equation that determines whether your strategy actually makes money. Expectancy equals win percent into average win, loss percentage into average loss. Let's say you win 70% of the time, but every win gives you $50 and every loss costs $200. Over 10 trades, you make $350 in wins and lose $600 in losses. You're down $250, even though you were right most of the time. Now, imagine another trader wins just 40% of the time, but makes $300 on average when right and loses only $100 when wrong. 4 wins give $1,200. 6 losses cost $600, and they walk away $600 in profit. The math doesn't lie. It doesn't reward accuracy. it rewards discipline. That's why every professional trader is obsessed with risk management. Richard Dennis, the man behind the Turtle Traders, once said, "You could be right on only 20% of your trades and still make a fortune if you manage risk properly." Their trading system wasn't about predicting. It was about reacting. If the market moved against them, they cut fast. If it moved in their favor, they held. That's the mindset of a professional. Now, here's where the real pain comes in, the math of drawdowns. Every new trader needs to understand this before they blow up their account. Let's say you lose 10% of your account. To get back to break even, you need to make 11%. Lose 50%, and you need a 100% gain just to recover. Lose 90%, and you need 900% to climb back up. It's brutal. That's why professionals risk only 1 to 2% per trade. They don't play defense because they're weak. They play defense because they're smart. Tudor Jones said, "The most important rule of trading is to play great defense, not great offense." Because in trading, your capital is your oxygen. Run out of it, and you're dead, no matter how good your next setup looks. Livermore learned this the hard way. He made millions multiple times and lost them just as many. His greatest regret? Not cutting losses soon enough. Soros said it too. "I'm only rich because I know when I'm wrong." That's the mindset that turns traders into legends. Not avoiding mistakes, but correcting them instantly. Let's be honest, cutting losses hurts. It stings. It bruises your ego. It feels like you're walking away right before the market finally turns your way. But here's the truth. Refusing to take a small loss almost always leads to a bigger one. That's the death spiral of new traders. One bad trade turns into 2, then 3, and suddenly you're averaging down, revenge trading, and watching your capital evaporate. Professional traders, on the other hand, understand that their number one job isn't to make money. It's to protect capital. Because if you protect your capital, making money becomes inevitable. Losing money is part of the game. Staying in the game is what matters. So here's the reality that separates amateurs from professionals. You don't need to win 90% of your trades. You don't even need to win half. You just need to make sure your winners are bigger than your losers and that your losers are cut before they turn toxic. As Ed Seykota famously said, the elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance.